This Week in E-commerce episode, I think it's 64, 63 or 64. I've lost count, Paul.
One of the two.
One of the two. We'll fix it up in the show notes.
Yeah.
We are back for another week of This Week in E-commerce, and it has been a huge week, as it always is this time of year, as we are well and truly into peak season. Paul, how are you feeling about everything right now?
Feeling good. I mean, there's a bit of an air of anticipation around. I think there's some nervous retailers in the group. You would have seen in our Slack channel some people, feeling a bit stressed about what's coming. But I think if you've done your homework and you've prepared well, you should be okay. And I think it'll be we've reported on this. People in previous podcasts, people are going to spend. We know that. So what are we now? We'll be, by the time this goes out, I would say there'll be. We'll be right among the thick of deals kicking off, even though it obviously will be well before Black Friday. We know people are going to start early. How do you feel about it all?
Oh, look, I feel pretty good about it. I think the analogy I made this morning to the team was that for a lot of clients, this is going to be cream, but for quite a few, it's going to be the whole cake. So there's a lot of riding on this for quite a few people. But the signs so far seem to be there that people are in a spending mood. The ARA recently said that due to the financial stress which a lot of people are under, they are really looking forward to spending. Like, people still want to spend, but they're very much looking forward to big deals. And obviously Amazon had their results, which they came out with the other week, about their recent Prime Day, showing that it was like about 50% up on previous years, which is insane. And with that, we've got Singles Day, which is today, which we're recording. We've got Click Frenzy coming up, and we're starting to see a lot of people, kick off with some pretty deep deals. So I think the appetite is there for people to spend, but also retailers just to really kind of go going a bit ham, I think, with some of what they're offering, just to recoup some of the lost sales from over the year, hopefully clear some stock. So look, I think it should be good. Should be good. And obviously, we've had some changes in government. Whether that means that's a good thing or a bad thing, we can dig into that a little bit later.
As long as it's over, that's the main thing. We've had enough of wondering what's going to happen. Now we can all get on with things, and off we go.
Yep, that's right. All right, we are going to dive into that a little bit later. But in the meantime, some not so sad news, but some news that Don Meij, the very well-known CEO and MD of Domino's Pizza Enterprises, and we don't talk about QSRs very often, but I just did want to make a call out about Don Meij because I feel that he's been a real pioneer in Australian retail, food service, whatever you want to call it. Like, he's been a real innovator, and he's retiring after 40 years in the business. He's been such a great driver of so much innovation in the business, whether it be robot delivery of pizzas, which he trialed. Even the very first Domino's Pizza app was out here in Australia. The very first online tracker, so you can actually see where your pizza is up to in the making process. Pioneer that here. So it's just he's just left such a remarkable legacy, and he's going to be stepping down.
Yeah, he started as a delivery driver in Redcliffe, Queensland. Domino's is This was when I saw this article, I was like, oh, wow, I remember this from my union days with the SDA. We had agreements with Domino's, so we would hear a little bit about Don. But what surprised me as well at the time was the size of that. I mean, it's quite a while ago, but it was the size of that business and how aggressive they were in expanding. And it's a pretty cool story, actually. Like, 40 years is a great stint. And as he says, it grew from a little Brisbane-based company to a global business. And I don't know, I've got a soft spot for Domino's, not just because I used to have to go in and roll out little enterprise bargaining agreements in tiny little stores and literally have to wait outside Borkham Hills store until like a driver would come out and be like, hey, because you'd have to get a certain amount of people to vote on the EBA. And so you'd be pen in hand, like 20, 22 years old, trying to get drivers to sign EBAs. But it was cool. They always had a good vibe around it. And they're good pizzas. I don't mind them. We don't mind a sneaky little Domino's, little Domino. I feel like they've shrunk over time now.
Shrinkflation.
Yeah, but good on him, man. 40 years in fast food, hectic.
And opening up 700 stores. So 500 stores in Australia, but then also another 200 across Europe, as well. So all from little old Queensland,
Yeah,
setting all that
100.
up. So it's an incredible legacy, just like what he's done. It's I can't think of anyone else who has been as innovative as they have. We've talked about Guzman and Gomez before. We've talked about some other QSRs, quick service restaurants, but really Domino's, like, they have just been absolute innovators in this space. I just saw as well that in 2017 they actually installed a Tesla Powerwall battery system in Sydney. So back in 2017 they were already pioneering a lot of this innovation, which we now kind of take for granted. And I'll never forget, like, the autonomous delivery as well. Just remember watching the video of this robot just going down the street delivering your pizza. It was going really, really slow, but I was looking at this and going, like, this is where the future is. And in the meantime,
he's not innovating then.
Yeah, but in the meantime, like, no one else has done anything like that. I don't know if they still do that. Like, you obviously see the delivery robots at sushi restaurants and things like that, but but never on the street.
100% right. Like, even thinking about 5 or 6 or maybe more, I can't remember, years ago. Remember they have the thing that you could. It was like a pizza going around to track it.
Yep.
And they were one of the first that had decent tracking, and they kind of gamified it by making it like a. Now, obviously, we take that for granted now with things like Uber Eats and so on. But back then, it was like, I'm going to log onto the website and I'd track it, because if you remember 10, 20 years ago, you have to ring them. Well, my driver's not here. They invested in that tech early, and you got to say, like, a lot of fast food has failed, and these guys have been around like a long time and prospered. So yeah, you're right, like a real innovator.
Yeah, and look, part of it's the reliability and the consistency. You know exactly what you're going to get. It's not going to be the world's greatest pizza, but it's going to get to you, like, within a certain amount of time. You can see exactly where it is. So look, well done, Don. You've had a great run there at Domino's. So let's see if the next MD will be able to achieve the same things you have.
Yeah.
All right, we're going to move on to Klaviyo now. So in a bit of a flip side, so Klaviyo was actually on a tear recently. So their stock went from $32 and they cracked $40 last week. And that was something which I was kind of like joking around with some of the Klaviyo team, just going, when's it going to crack $40? And they were all eagerly just like, it's going to crack 40, it's going to crack 40. And then they came out with their earnings report, because it's Q3 earnings season. And I thought their results were fantastic. They were showing 54% year-on-year growth, which is incredible in this climate. They're showing like returning run rate of customers 110%, which is also fantastic, and a lot of really great results they were reporting on. But yet somehow the market absolutely punished them, and they saw a 30 odd percent decline in their in their share price after their earnings report. What is going on?
Didn't we talk about something similar last week? Was it last week?
We did. We talked about Meta. We talked about Meta and Crocs, about how they were punished. But then just see Klaviyo also being punished, despite what I thought was actually pretty stellar numbers, showing that sort of growth. It made no sense to me.
Well, yeah, it doesn't make any sense to me as well. But sort of like last week, you sort of say, well, the market was punishing those companies we spoke about last week or the week before for they grew, but they didn't annihilate their expectations. And like these are great. These are great results. Like absolutely killing it. But to get punished again just reminds me of why. Like the more you know about the stock market, the kind of like the worse you perform as an investor. I think, because it just doesn't make any sense. I think I don't know, like maybe in tech or e-commerce or whatever, it reminds me of Afterpay days. Maybe we're just a bit, I guess, greedy, and we think like, oh, you only did 34% year on year. You should be up 134% year on year. It's not sexy enough. So I think it's, I don't know, maybe we've built a rod for our own backs here with some of these wildly successful tech businesses. But from a pure, forgetting the publicly listed, the share price, from a pure performance point of view, like that's amazing. Klaviyo have absolutely done everything that they've been asked to do and more, I would say, since IPO. So yeah, good on the Klaviyo team, and obviously the ones that we know here in Australia as well, because they're stellar numbers.
Yeah, I can't imagine that they'd be overly phased about it. Yes, it's disappointing, and obviously you are beholden to shareholders at some point. But at the same time, I think their growth. You look at these numbers, I would see this as being a blip. I'd be curious what the next quarter's will show. I think there's just like you said, a bit of an expectation right now that shares are just going to be like if you're not hitting your numbers and smashing, annihilating the market, you're not doing well enough. But Klaviyo well on the path to becoming profitable. I think that they're anticipating next year at some point to become profitable, which is going to be great considering like how far they've grown and how much of the market they still have yet to capture, as well, and doing so relatively efficiency. Because when you look at how their operating loss as well, as a percentage, it's continuing to decline. While revenues are increasing, as a percentage, their losses are decreasing, and that's exactly what you want to see. That's a really positive trend. So we'll see what happens next quarter with them.
I think there's good value here. Like, just on a side note, that's still up 43%. The share price still up 43% over 6 months. But you look at I think it'll. I'm no expert, but I think it'll correct itself. Like, again, it's just silly. Like, and it's happened to them back in a little while ago, back in July. It just goes boom after some news, and then it just bounces back. So I think they're just doing good business. I think there's value there at that little drop. So that could be one to watch.
Yeah, look, I think there's a lot of innovation coming from them as well. They've invested really heavily in building out their capabilities of the platform. So whether it be introducing SMS, introducing other new features, integration with Canva, which apparently drove a lot of new customer acquisition, and also extending it to new languages. I was actually kind of surprised that Klaviyo was still primarily in Australia and the US, where it was kind of like seen as being like the default. But when you go to Europe, there's so many other competitors, including ones I've never heard of before. To think that now they're expanding into other markets as well. There's still so much room left to grow for them.
Mal, this reminds me of I'm just looking at stuff here. A little while ago, back in 2022, actually, we spoke about Shopify's share price dropping to $30, down from 169. And I said, well, I'm going to buy it because I don't think it's anywhere near the end. And now it's $86. So we were right on that one, that Shopify was a good buy, and I still think Klaviyo is a good buy.
Yep. All right, moving on. We are going to talk about the climate a little bit. In particular, that there is mandatory reporting for emissions. Sorry, not emissions, but we are going to have mandatory climate reporting soon for a lot of companies. This is something which is going to be rolled out progressively over the next few years. In particular, that this is something they're expecting to really hit fast fashion in particular really hard. So they're showing that fast fashion has grown quite a lot. And we've talked about this before as well, that fast fashion has grown by 9.5%, according to an IBISWorld report, to a market cap in Australia of $2.8 billion, which is a gigantic number, which we're spending in fast fashion. And fast fashion, it's really about that disposable fashion, which is really cheap to produce, can quickly jump on trends and get to you really fast. But now with the mandatory reporting, which is expected for large businesses, which is going to be phased in. It's going to be phased in, first of all, with businesses earning over 500 million, and then gradually, 50 million, and then going down to 50 million, which is going to cover a lot of the larger fashion retailers here. So I think smaller ones won't be impacted yet, but I think the larger ones, definitely kind of would be, where they'd be talking about like, I'm going to call out some names here, like, White Fox, for instance, who you'd probably term fast fashion, whether that's going to be something which, how much it's going to impact their business and what they're going to be have to think of to be able to adapt to this new regime.
Yeah, I mean, 50 million appears to be the threshold. So that's actually quite a few brands that will probably be listening to this, and quite a few brands that we know. So it looks like you'll have to do something here if you're in that fast fashion category and you're over 50 million. It looks like you have to do a little bit of research on exactly what's required. But rolling out from next year. So yep, if you're doing 50 mil and you're in fast fashion, you're going to have to do this climate reporting. I think it's a pretty big job. Kind of reminds me of it says the Modern Slavery Act was the last time they did this. But yeah, look, it's needed, Mal, because like we talk about ESG and stuff a lot, and there's been a lot of noise, and we always say it's a little bit of lip service. I think we sort of say, I think eventually this will settle right in and people will shop with a conscience. But at the moment, I feel like brands are investing in this for the future, and that they don't always make big revenue. In fact, a lot of these businesses struggle. I do think it'll pay dividends eventually. But even looking at what you just said there, IBISWorld has reported, what did you say, 9.5% growth in Australia in fast fashion. So it ain't slowing down, is it, Mal? Like, people still like to buy cheap clothes. That's a lot don't, but more do, and that's the point. Particularly in a economic crisis, people do look for cheaper stuff. So it reminds us that it's still a little bit of a pipe dream to think that consumers will shop like this en masse. We know that they're starting to, and again, I'll say I do think it's going to cash in for those people who have targeted that market now at some point. But it just shows you another 9% growth. Something's got to happen, and good on them for doing this. We'll have to get more across maybe what brands will have to do, Mal, because there'll be some people starting to get a little bit nervous about what they will have to do to comply.
Yeah, from a consumer point of view, it's like we've attempted for many years to really lead with a carrot approach, like kind of incentivizing people and telling them that they're going to be doing the right thing if they do choose to buy from a more ethical manufacturer. But at the end of the day, it's like the behavior doesn't change. Like, particularly cost of living pressures, we just want cheaper and cheaper and cheaper, which is why brands like Kmart are doing really well. Cotton On continue to do well, and a lot of those lower cost brands. Whereas, like, we talked about that middle of the middle is going to get squeezed. So with that, the carrot's not working, which means that we need to now lead with the stick. So this is definitely very much a stick, but a stick, thankfully not for consumers, but a stick for the corporations, who ultimately are the ones who need to be incentivized and motivated to do something different. And if they're now going to be forced to undergo mandatory climate reporting, they're going to need to really understand what their supply chain looks like, and there is going to be an overhead with that. They need to actually going to be able to justify why they are doing certain things, why they are not meeting certain standards when it comes to emissions. Whether this then leads to penalties potentially, or whether it's just something which is going to have to be like front and center on their products when they go to a website. It's like, bang, this is like this is your emissions reporting. You're a level 1 or a level 2 or a level 3, whatever that is, and whether that changes behavior. But I think at the very least, just like having that reporting and making it more transparent, should help. And also because of the additional pressure this puts on the retailers as well, whether they're going to adjust. And that's my hope with this. And I believe that's a lot of people's hope, that people are actually going to start thinking about their supply chains a little bit more, about how do we move away from, whether like polyester, acrylic, really a lot of these very emissions heavy fabrics and materials, towards something more sustainable, like organic cotton, for instance, which I know brands out there, like Upstage World, who we've recently started working with, but then also which Snuggle Honey have been doing for a while. And it's a change which needs to happen.
Yeah, I think that's all fair. Yeah, I think it's just got to be fair on we've got to make sure that the foreign sellers, remote sellers like your Temus and stuff and your Sheins are also held accountable. I don't know how that'll happen, Mal, if they're not kind of domiciled here in any way, but that'll be the challenge for me. Is it's okay to set these rules for locals, but you got to hold the big players that are selling from overseas to account as well. And if they do, you would imagine that will level the playing field a little bit. But I don't know how they will, to be honest. I don't know how they will hold your Sheins accountable.
Yeah, well, that brings us up to our final topic of the day, which is talking about the second Trump presidency. So for those who may not have heard, Donald Trump has won the White House for the second time. And with it, he is also making a lot of claims that he will be doing a lot to actually have a more nationalized focus for America and what that country is going to be doing. And one of those things is it is going to impact how a lot of businesses deal with America, both from a trade, but also from a political standpoint as well. Paul, have you been thinking about this a lot? Because I know I have. I've been thinking a lot about what this could potentially mean with a second Trump presidency and a more inward-looking United States.
Yeah, I don't know. I think a lot of people were just waiting to know one way or the other, and then kind of watch what happens with consumer spending and with share prices seem to have surged a little bit as well. I think the big one for retailers here is kind of what we already knew, is that if you're going to sell into the States and you're selling certain categories like clothing and so on, that you'll be required to pay a tariff, a duty rather, on made in China products. So that's one, Mal, that got about a year to get across, but essentially that'll mean that you're going to have to pay roughly in the vicinity of 22 to 25% for the privilege of selling into the US. So that's not necessarily something that's happened since Trump came in, but we know that it was it was supported by all anyway. So that's pretty major, I reckon, for a lot of people in our industry. That's the main one for me, is just brands getting across how they're going to tackle that. But otherwise, I think the consensus for me is just like, well, one way or the other. I'm glad that this is over and we can kind of get back to. I have seen a slowdown in spending, I reckon, and a slowdown in spending in the US. And I did notice in Meta, particularly, a lot of CPMs were really high and conversions weren't there. So I'm not sure if there's been like low consumer confidence in the lead up to this. Hopefully that's back, and particularly for Aussies selling there, we can pick up some more traction, because I feel like the last 3 or 6 months has been pretty uncertain, Mal, and pretty tough selling into the States.
Yeah, and I think there is a glimmer, I guess, positivity, and this obviously, I don't know whether it's off the back of Trump winning that this decision was made. I kind of hope it wouldn't be, but the Federal Reserve recently also cut interest rates, so now the US has actually had 2 successive interest rate cuts, whereas we're kind of like still holding steady on ours, and this is something where interest rate cuts then lead to more consumer confidence, because people are now feeling more confident about spending. So whether this then transfers through to retail spending, so they'll be looking to spend more, and whether they choose to then spend more domestically or look to spend more overseas, because this then hopefully then will lead to greater consumer confidence, which will lead to a strengthened US dollar, which then suddenly makes Australian products quite appealing if the US dollar strengthens in comparison to the Australian dollar. So that could be an opportunity for retailers here, before those tariffs kick in, to actually start targeting more of the US audience as well, who may be interested in buying their products. But then there's also the issue around supply chain as well, where in particular a big focus for the second Trump presidency is to be able to have more manufacturing in the US. Whether anybody here who is supplying goods to the US currently to US retailers, whether that opportunity from the more wholesale and B2B perspective, whether that kind of goes away because there's more of a focus towards buying onshore. There's so many things at play.
Yeah, you make a good point about the currency, right? I think I think the confidence is back. The interest rate, should come back. The interest rates being dropped should help spending. If the US dollar strengthens, Aussie brands become cheaper, and that potentially gives us a little bit of wiggle room to lift our prices and get some more margin out of the US as well. So there's a hell of a lot at play here. But there's no doubt, like particularly amongst the bigger Aussie retailers or the bigger Aussie ecom retailers, if you're going to kind of get to 50 mil and above, for most of us, not all of us, that's going to probably mean that around 50% of your rev's going to come out of the US. So major impact for Australians. And I do feel like the US just went cold. That's what I feel like over the last 6 months. So let's see what happens here, if it bounces back, and then hopefully we can get a couple of rate cuts in 2025 as well, and start to get things moving here, because it has been a tough 2024.
That's the dream, Paul. That's the dream. We're kind of hoping for one before Black Friday.
we were. I think let's get Black Friday done, and a nice little one early next year would be a good way to kick things off, I think.
Yep. Just thinking as well, like whether this is also something which a lot of retailers thinking about, should be thinking about holding US currency as well, particularly if we're seeing a strengthened US dollar. If you are paying your manufacturers in USD, which a lot of people are, you don't want to be converting that from AUD to USD to pay for it. If you are selling to the US, you should probably be thinking about holding it in USD, I would say.
Yeah, I was just thinking back to when I was long time ago doing importing and stuff, and the dollar was like parity. It was like dollar for dollar or 89, and then it just went and started sliding to like 66 cents today is like unheard of 10 years ago. So you can erode your margins completely. So I think that's a big call. We used to do sort of hedging back then, but I think you're right. Like if you're selling into the US, use like a Airwallex or something, super easy just to hold your funds and pay out some suppliers. But yeah, I think particularly bigger brands, like a couple of % on FX matters. So I do think you're right, and the brands should look at their USD strategy.
Yeah, absolutely. All right. On that note, that's all we've got time for today. Paul, any final thoughts before we call it for another week?
Not really. I hope everyone's feeling calm and peaceful about Black Friday, and more importantly, thinking about what they're going to do after Black Friday, because I think December's going to be a bit of a tough slog unless you have something coming up. Because also we have our freight cutoffs midway through the month, so start thinking about your Decembers and your Januaries and Februaries, because you should have done your buying for those by now as well. That's about it. Mal, what any final thoughts from you?
Similar to you, just making sure everyone's just think like a squirrel right now. Like squirrel away all your nuts for the winter of December and January, because it's probably going to be a bit soft from what everyone has been saying, including the ARA, who are saying that a lot of people have made their choice. They've been building their wish lists over the last few weeks, looking to now spend and buy those wish lists in November. And even talking to my wife, she's like, yeah, I'm doing all our Christmas shopping like this week. It's like, okay, cool, great. Got to figure out where we can hide it around the house so that the kids don't find it, because she's not looking to spend anything in December. And I think she is definitely, for me, a bit of a bellwether in terms of what the consumer sentiment is like at the moment.
I think that's a good tip. Squirrel away some plans and some strategies, but also some cash. Hold a bit of that cash, because I do think it'll be a bit quiet.
Yep. All right, that's all we've got time for. Thanks for joining us again on This Week in E-commerce. Have a great week.
Thanks, guys.